Mr. Choradia is a senior member of CI Western Region and is also the past chairman of CI Madhya Pradesh State Council. Over to you, Mr. Choradia.
Yeah, thank you, Harsh. Good evening, friends. CI Western Region Subcommittee on International Trade and Investment is today pleased to organize another webinar on a very interesting and useful subject, demystifying cross-border financing. And today's focus will be more on foreign exchange borrowing and guarantees. And for this session, I am pleased to welcome our guest today, Ms Karishma Vora, who is currently a barrister in England, and she has the dual advantage of working in India as an advocate here. She is from 39 Essex Chambers, and Mr. Phani Shankar, who is President and Business Head Forex in Kotak Mahindra Bank. I also welcome all the participants on this session. And the moderator for the session today is our own Mr. Kannan, who is a corporate and financial advisor. And I am expecting that Mr. Kannan will bring the best out of these two experts who are on the call today, and look forward to a learning session. So over to you, Mr. Kannan. You are muted, Mr. Kannan.
Yeah, good evening, Mr. Chodia, Ms Kashmira, Mr. Shankar, and Mr. Karishma. I am very, very happy to moderate this session on demystifying this foreign borrowings. If you look at today's world, more than $20 trillion of funds around the world are attracting a minus interest. There is a very, very high liquidity in the system, both in the world and in India. India also, I believe there is a liquidity of more than 8 lakh crores available. So this has also opened up a lot of opportunities for Indian corporates to go and borrow from abroad at very, very attractive rates of interest. But of course, there is always a caveat that you have to take the cost of forex cover as well as the other risks which are there. So today, to demystify, we have very experienced professionals in this world, in this field. Mr. Shankar, who is with the Kotak Mahindra Bank as a President and Business Head of Treasury. He has more than 25 years of experience, and he is from IIM Ahmedabad. And he has worked with leading banks like Stanchart, IDBI, and before Kotak Bank taking over, he was with the Asia Bank. So he has a very good exposure for forex trading, treasury, as well as he has a very good experience in the various products, forex products, relating to the products that are being used by corporates. So he will be talking to us about various products available which corporates can consider for funding their requirements. Then we have Ms Karishma, is a very young, energetic, a very popular lawyer. I was just reading the biodata of her, which runs to 7-8 pages. And one good thing is that she has more than 15 years experience. And she was ranked in the Legal 500 of the year 2020 as a leading junior for commercial litigations. So she has her office in UK. She has her office in India. So from 2011 onwards, she is practicing this English law, and she is specialized in aspects like external commercial borrowings and entering into these agreements, litigation, arbitration, And if you go through a list of cases she has handled, I think if you think of type of a case, she has handled every type of case which you can think of in terms of these disputes and arbitrations. So we have these two eminent experts with us. Without taking much further time, first I'll request Mr. Shankar to go ahead with this presentation on various products and what are the options corporations can look at in terms of raising funds. After that, we will have Ms. Karishma, who will talk about ECB as well as the various aspects of legal procedures. Then in the meanwhile, whatever queries you have, you can put it in the box. So we will have all the queries after the presentation by both of them. Now I will request Mr. Shankar to go ahead with his presentation speech. Thank you. Mr. Shankar, you are muted. Mr. Shankar, we can't hear you.
Oh, I'm sorry.
Yeah. Please start from beginning. Yeah.
I'm sorry.
Thank you.
Yeah. Thank you, Mr. Kannan, and thank you, Mr. Chordia, for the introduction. Okay, this is a presentation on foreign currency borrowings from a practical perspective, or should I say a practitioner's perspective. I've tried to put here things that I've drawn in my experience of how various corporates have dealt with foreign currency borrowings and how they deal with them, and what are the considerations that go into getting into a foreign currency borrowing from all of these. It is not so much to talk about pertaining to it, which is to a large extent. Quickly move on to what how you should manage those, how you can make more of the foreign currency borrowings. So in the next slide, so this is an overview of the borrowings. Like I said, not so much on actually what is all the avenues that are available, but I always look at foreign currency borrowings in three buckets. One is trade financing, which is mostly short-term financing, and this is usually self-liquidating. So if you do export financing, you can take either pre or post-shipment financing in foreign currency. This is generally very low cost of funds, and the reason it's low cost of funds is threefold. One, that it is very short-term. Two, that, like I said, it's self-liquidating in the sense that you take a finance against a bill, you give the bill, and if you perform, then it gets liquidated, so the risk for the bank is low. But the single largest reason why this is so low in terms of cost of funds is that export financing qualifies as priority sector for most foreign banks in India, and therefore they have a regulatory obligation to do for export financing. And therefore the competitive pressure on export financing drives those costs quite low. The other financing which is obvious on the trade side is import financing, buyer's credit and supplier's credit. The most common one is buyer's credit, and I'm sure everybody on the call would have experienced both export and import financing at some point of time or the other. Buyer's credit is not mandatorily guaranteed, but is almost always guaranteed by an Indian bank. There was this, a few years back, there was what was called an LOU until a few mishaps hit the banking industry, and then it turned into either guarantees or SPLCs that Indian branches issue. The one thing that most people don't consider very actively is that a buyer's credit is usually on the back of an LC, and the tenor of the LC plus buyer's credit has to be less than the working capital cycle. Now, a lot of corporates don't take this very seriously, and they don't see this consideration, but that's something to keep in mind so you don't elongate the duration of your funding. But that said, that was to put in context the trade financing. The bigger issue, the bigger topic for today and what we're going to discuss a lot more is on managing long-term borrowings. A simpler part of the long-term borrowing is import financing and buyer's credit capital import financing and buyer's credit on back of that. Now this can go all the way up to 3 years. Again, it is something that's commonly used by companies which have a large import component and especially capex. So you'll see this very commonly happening, being availed by companies who are doing, say, solar equipment or large capex or machinery imports, which is all capital in nature. And so they avail financing for 3 years under the buyer's credit window and elongate it further if necessary using rupee financing. The big topic for today is obviously external commercial borrowings. And I'll talk a little more about external commercial borrowings in subsequent slides. There is one other small window for foreign currency borrowings, which is colloquially called FCNRB loans. This is because historically, Indian banks could take deposits from NRIs in foreign currency, and the deposits were called FCNRB loans. But then the permission for banks is slightly more than FCNRB on the liability side. It also includes, say, balances of customers in EEFC accounts and some nostro balances. Now, these are the liability side of the bank's balance sheet, which can be used to provide loans to corporates. Now, if you see the difference between the first two, trade financing and long-term borrowings, and FCNRB has almost no end-use restriction. I mean, whatever is bankable financing from a rupee side is bankable financing for an FCNRB. So it can be very short tenor. The pricing is fairly flexible. ECBs come with pricing caps, and trade finance also comes with pricing caps. But the challenge with FCNRB loans is that the corpus available in the banking industry is very limited. You're limited by the amount of deposits, foreign currency deposits that the banking industry has. So it's not a very large corpus, but it's a fairly flexible form of foreign currency financing. Now, the big consideration is, why would you take foreign currency financing, and why is this the most attractive way, or what is most attractive about foreign currency financing? But before that, let's take a quick look at what should be your considerations when you look at foreign currency financing, which is on the next slide. On the left, I've put here the regulations that guide foreign currency borrowing, ECBs actually in this case, from a minimum average maturity perspective. Now, if you look at this, historically, we've evolved a lot. At one point of time, ECB was supposed to be largely long tenor, capex, and non-prepayable. In spirit, that's how the ECB was. But over the years, the regulations have progressively eased. So much so that today a manufacturing company can take $50 million up to 1 year. So the minimum average maturity, which was between 3 and 5, depending on usage, has now come down to 1 year. And there are various other buckets in which the tenor restrictions apply. In spirit, the regulation is still that if you're using it for working capital, use it only for long tenor purposes, or use ECBs for capex purposes. So if you see both of these conditions put together, ECBs are usually between 5 and 10 years of minimum average maturity. Now, when you look at foreign currency borrowings, one of the consideration is obviously the regulatory requirement, and the second is the need to tide over various currency cycles. And I'll talk about that a little more because on one side of the ECB is clearly the low-cost financing. Today, LIBOR, even at 1 year, is about 35 basis points. So 6-month LIBOR is over 25 basis points. So even if you pay a spread of 150 basis points over LIBOR, which is an indicative rate that I'm taking for illustration, you're talking about 175 basis points, 1.75% all-in cost of a foreign currency borrowing. Now, that is the attractive side of it. But the downside of it is the interest rate risk and more importantly, currency risk that comes with it. So I'll talk a little more about currency risk in the need about tiding over cycles when you take a foreign currency borrowing. The second is how do you compare the costs of various foreign currency borrowings? So for example, if you look at say euro interest rates, they're negative. Dollar interest rates, like I said, are about 0.25%. Rupee interest rates could be about anywhere between 5 and 6% today, depending on tenor and credit rating. So how do you compare each of these and assess, because these are apples and oranges. So that's another thing I'll talk about subsequently. And the third one is the choice of currency. Should you go for the cheapest to borrow? Should you go in for currencies where there's a natural hedge, or should you just hedge the whole thing out? And how do you manage all of these risks once the risks are on your book? To my mind, these were the four considerations. And as I look at corporates across who deal with foreign currency borrowings, I see all of them grappling with these questions, one or more of these questions at various points of time in their cycle. So on the next slide, I'm addressing this issue of how do you compare equivalent costs across various currencies. The simplest way to do it, and this is a textbook solution, but I find this very practical on how to do it, is when you're evaluating options, bring all options down to just one base comparable currency. So the easiest way to do it is if you're doing a dollar borrowing, for example, and if you see here as a borrower, you're paying dollar interest and dollar principal out, you can enter into a swap with another bank, or at least get a theoretical pricing, where you tell the bank, you give me the dollar interest and dollar principal, and in return, I will pay you rupee interest and rupee principal. So effectively, the dollar loan has translated into a rupee loan. And then you can do this for any currency. While I've given in this example as just the dollar, it could be euro, it could be yen, it could be just about any currency. And if you translate all of this into equivalent INR cost, then you have a good parameter to compare where the costs are. And then you know, on a theoretically fully hedged basis, which of these makes sense. Now that's one part of the evaluation. The second part of the evaluation is where both risk appetite and a little bit of a view also kicks in. And I've seen corporates move the entire extreme. On one side, they go in with fully hedged, so there's no residual risk that they run. They go in with partially hedged risks, which is either they hedge the exchange rate risk or they hedge the interest rate risk. And the other extreme is completely unhedged positions. So then you can put your risk appetite into this and say, if I don't hedge the interest rate risk, my cost is a little lower than a fully hedged cost, but then the risk I run is that LIBOR could actually move up, or whatever, my floating interest rate in foreign currency could move up. So that gives you the additional evaluation. The one that I've seen most people consider when they do foreign currency borrowings is when they look at natural hedges. And for a long time, we always believed that exporters have a natural hedge, and therefore exporters should take foreign currency, long-term foreign currency liabilities. Or we say that people who've got overseas assets should take long-term foreign currency borrowing. So, you know, your asset and liability side are matched off. Now, natural hedge is a very slippery path because a natural hedge is something that looks good on paper today. It may or may not pan out in the way you intend it as you go by. So you have to be very careful about your source of financing, your source of funds, and how you're going to finance your short-term borrowing. I'll give you examples of each of these in the last slide, in which I'm going to talk about organizational consideration. But before I get there, I wanted to put the theoretical frameworks together so we can look at what issues people really face and how they address it. So let me get to the practical aspect of how do you tide over cycles. Now the graph here is rupee. Now, assuming you stayed completely unhedged, and in this I've just taken 5-year cycles starting end of 2000 and every 5 years from there, so 2001 to 5 and 5 to 10 and so on. Now, if you look at the annualized depreciation of rupee, 2001 to 2005, the annualized depreciation of rupee was minus 1.1%. That is, rupee actually appreciated. If you take point to point and you annualize it, rupee actually appreciated by 1.1%. 5 to 10, it depreciated 0.27. 2010 to 15, and that's when we had 2013 taper tantrums. It depreciated 8.15%. And 2015 to date, as of trading hours that I had taken at 74.05 in the middle of the day, it's 2.35% annualized. Now, the reason I put this is the second column here, which says equivalent INR costs, is a very rough calculation to tell you that if you took a 6-month LIBOR borrowing at a spread of 150 basis points, which is bullet over 5 years, and left it unhedged, what would have been your INR equivalent cost during that period? So in that theoretical situation, 2001 to 2005, the INR equivalent cost of that would have been 3.08%. And you can see that that cost varies very widely. It's 10.12 to 2010, 2015. Now, please don't look at 2010, 15, or any of these 5 years buckets as sacrosanct. It's just an illustration. And if you pick different periods, the examples will look very different. So, for example, if somebody took a loan in, say, 2013 for 3 years, or 2012 for 3 years, it would be a lot more expensive because that's a period of steep rupee depreciation. So it depends on where you catch it and how much depreciation you actually suffer. So, and this is the point I was trying to make when I said you got to ride over the cycles. At some point you go up and you go down, but you have to be careful about how much of the depreciation impact is being hit. Now, the right way to evaluate this is if in 2001, if a AAA PSU yield, and I use that as a proxy, 5-year AAA PSU yield in rupee terms was 9%, and instead they took a foreign currency borrowing, they would have ended up at 3.08. So the savings is significant. But if you were in 2010, 2015 cycle, between 8.94 and 10.12, you would have been worse off with a foreign currency borrowing than with a rupee borrowing. So the consideration that you should have is really, are we willing to tide over the cycles, and how many cycles are we willing to tide over? And what is the amount of rupee depreciation that we can stomach if we leave the ECB unhedged? Now, a lot of people who look at ECBs unhedged actually have something at the back of the mind which says they have a natural hedge. So I want to go back into the most difficult part of the ECB consideration, which actually is the practical side of organizational dynamics, which is there in my last slide. And I'll illustrate this with a few examples. And all of these are examples that I have seen in my career with various people. The first that I always learned is that when corporates say they have a risk appetite, it's always subjective. There is never a measure for risk appetite. And I have seen boards of corporates swing very dramatically from one end to the other. I've seen boards which are very pro foreign currency risk suddenly wake up one day and say, how could you guys even take a risk like that, and vice versa. So a risk appetite is something that's not known, which is exactly why the evaluation of the foreign currency borrowing has to be very good. The point about security, the clauses and security conditions, because foreign currency borrowing is perceived as low cost, a lot of people agree for clauses and security conditions which are sometimes onerous but sometimes reasonable. I've also seen that banks who give ECBs also ask in return for local businesses. So, for example, there might be a large bank that has no big presence in Asia, but it's willing to give you an ECB, and the bank says, but in return, I want some local cash flows, I want some local funding opportunities, I want your liability business. So that's the other quid pro quo that you need to manage on. What are you willing to give to the corporate and how, to the bank, and how you will manage it? This thing about who has signed off on foreign currency debt, I'll give you an interesting anecdote. Many years back, it was a company who had, it was a 100% exporting company, and from its global partner, as a part of their capital structure, the global partner had agreed to give them very long tenor, zero cost foreign liability. And these were days when Indian interest rates were flirting with double digits. Now, it was all fine until one day suddenly it hit, and then the board panicked. And then the board said, doesn't matter whether it's zero cost because it's no longer zero cost, it's the depreciation, let's just go out and hedge. And they did a complete U-turn and went out and hedged, and their hedge cost, peak of it was so bad that they paid much more than they would have paid for a rupee borrowing any time during the cycle of this loan. Now, what changed? What really changed is that their initial strategy and the reversal was driven by panic and greed. So one of the important things in this consideration is to stay in and don't change your strategy. If you go in with this, which is why the point about who in the organization has signed off on the foreign currency debt. As long as the board and the CEO are aware and this is the risk that you're taking and this is what you will live through on cycles, it's important to just stay in. The second is what are the residual risks you run? I've seen, for example, we have a large client who's got a foreign currency borrowing, and a few years back, they woke up and said, currency is something that we can manage because we've got exports on the other side, but interest rate is not something that I want. And so when dollar LIBOR was about over 2%, they went and hedged out their interest rate risk for the next 5 years. Now, so it's not a bad strategy. It's just that that's a risk that they did not want. But now if they look back at it in hindsight, it looks like a very foolish hedge to have taken. They've probably been better off just running the LIBOR down and enjoying the lower interest rate. Again, the good part about this corporate is they've not panicked and they've just said it's a decision taken, it's fine, and we have evaluated the decision at the time we've taken. But if that had not been evaluated and you did not have internal buy-ins, a lot of internal friction, board, management, and executives and the finance officials creates friction. So that's the other thing that you need to know about residual risks. I'll give you just two other examples. That is,
Mr. Shankar?
Yes, Mr. Shankar.
Maybe you can take 2-3 minutes, then later on during the Q&A we can. Yeah, you can.
So I'll just start with just two examples on this. There's a company who had long-term foreign currency receivables, and against that they took a foreign currency loan, and they therefore had a natural hedge. But during the COVID pandemic, they suddenly realized that their export earnings have dried up, and the export earnings have dried up in a more permanent manner than they thought. And the visibility of getting that back has gone back by a few years. But in the meantime, they have a foreign currency borrowing. That's why I said natural hedges is a slippery path, so you should be careful not just about the quantum of your currency receivables, but also the sustainability of those foreign currency receivables. And the other example I want to give is an exporter who said, yes, I have long-term exports and we will take a foreign currency borrowing against it. But as they went through each year, they were also financing their export through short-term foreign currency borrowings. So if you look at it at any point of time, they not only had a long-term but also a short-term foreign currency borrowing, and then their net exposure was probably more than their net foreign currency receivable. So some of these are that you need to keep in mind when you take these long tenor borrowings. And obviously implications on accounting, especially hedges, because the get mark to market and goes to P&L, and management information on how your transactions are doing. So I'll broadly stop here and we'll take questions as we go by.
Yeah, thank you, Mr. Shankar, for an excellent presentation on these products as well as the risks involved and what corporate should look at from an organization point of view. Now I will request Ms. Karishma to make her presentation. We will have a Q&A at the end of the presentation by Ms. Karishma. Yeah, please. Ms. Karishma, please go ahead.
Yes. Yeah. Thank you very much, CII, for organizing this, and Raj Ratnam for sponsoring the event today. And thank you, Mr. Shankar, for the tour de force of external commercial borrowings as well as other possibilities in foreign exchange borrowings. Would the CII IT department please be able to put my slides up on the screen? And I hope that what I am about to say will tie in very nicely with what Mr. Shankar has said. So I'm going to focus on one aspect of Mr. Shankar's talk, which is external commercial borrowings or ECB loans. I'll speak very briefly about documentation and what lenders as well as borrowers would like to pay attention to. And then I'll speak about defaults and what occurs when a borrower is unable to make payment. Can we have the next slide, please? So as Mr. Shankar said, ECBs or external commercial borrowings are simply loans. They're usually from foreign lenders, and typically the ones that I've seen tend to be in USD and euros, even if they're borrowed from the foreign branches of Indian banks. So for example, let's say ICICI London or Punjab National Bank London, SBI London, etc. Even though they're in London, I would typically see a borrowing in USD or euros. And again, they typically tend to be around the 20 million mark, or at least the ones that land at my desk are 20 million and above. And they can be used, as Mr. Shankar has already alluded, for working capital requirements, as well as to repay Indian borrowing. And it's important to note that these are regulated. So especially if you're an Indian borrower, you will be regulated in your foreign currency borrowing by FEMA, the Principles of the Foreign Exchange Management Act, as well as RBI's circulars. And there is a master circular on ECBs or foreign exchange borrowing. Can we get the next slide, please? Now, the documentation tends to mainly be one main facility agreement. So that's the loan agreement. And then that tends to be supported by a number of ancillary agreements. So, for example, there can be two types of ancillary agreements. One is swaps and one is guarantees. In swaps, as Mr. Shankar has again said, it tends to be interest rate swaps and or foreign exchange swaps. And sometimes there are loan agreements that don't have a swap at all if the management has taken a decision not to take a swap on. And the second is guarantees, and they can be guarantees that can, manifold guarantees. For example, corporate guarantees from, say, the parent company in India, who may be a corporate guarantor. There may also be guarantees given by the directors of the companies, so personal guarantees. And lastly, there may be share charges or share pledges. And again, it depends on how it's structured, but it can be a pledge of the Indian company's shareholding. It can be a pledge or a charge on the promoter's shareholding in their main entity in India, and so on. It's very important to actually get this right because, sorry, can we go back to the previous slide, please? I think we're going forward. Can we go back, please? I think, Harsh, if you can go back to the second slide is what I'm looking for. Yeah. So the borrowers, if you are a borrower, you may want to pay attention to a few clauses. To begin with, it's the FEMA, it's not necessarily a clause in your contract, but it is a consideration that you will need to take account of. And I'll give you an example. One of my clients was a perfectly healthy Indian company, had never had a default for, the major part of 50 years or 5 decades, and decided to venture out and start a business abroad and borrowed an ECB. They didn't hedge it. They didn't hedge either the interest rate or the foreign exchange rate. But what they didn't realize is that the Indian corporate that was providing the guarantee, they chose a particular entity within their organization. And under FEMA rules, then FEMA rules, it could only have provided a guarantee up to 4 times its net worth, but the guarantee provided was far greater, and therefore they were in breach of the FEMA regulations. It also happened that the foreign business didn't do as well as they expected, and they were willing to transfer money from one of their other group entities to repay the London-based bank that had granted this loan. Unfortunately, the Indian authorized dealer said they accepted the money and then they returned it the next day and they said, oh, sorry, we can't actually transfer this money abroad because this is your guarantee is in breach of the of FEMA, and therefore you're also in breach of RBI's guidelines on ECBs. And so even though you can repay this loan using your Indian money, we can't actually transfer this money abroad. And then they found themselves in an extremely tricky situation and now are facing court proceedings abroad because they're not able to transfer the money out of India and their foreign businesses haven't done as well and therefore they can't repay using their foreign business. And so it's very important to sort of keep these dispute scenarios in mind, even though you don't foresee ever being in default. The second that a borrower, clause that a borrower may like to bear in mind is the clause of the appointment of receivers. So every share charge will tend to say that under the English Law of Property Act, receivers can be appointed directly. And this means that you don't need to, or rather the lender will not need to go to a court to appoint the receivers. They will be able to just, by way of contract, appoint the receivers. And even before the lender initiates any legal proceeding against a defaulter in London, they will the receivers will just be able to sell the assets. And I'm doing a case right now where the receiver sold the assets literally a week before the trial was to take place and a week before the judgment was pronounced. So that is how quickly receivers who are not appointed by the court but appointed under contract can move. And the reason I'm focusing on English law is because nearly all external commercial borrowings will say that the contract is governed by English law and that in the event of a dispute, it will go to court in England. And that brings me to my next point, which is something that the lenders need to bear in mind. And what tends to happen is, as I've previously mentioned, there tends to be at least the facility agreement, which is your loan agreement, but also guarantees, also share charges, and there may be hedges. Now, while the facility agreement will always be governed by English law and will go to English courts, some guarantees may say it's governed by Indian law, and let's say the courts in Delhi or the courts in Bombay, etc., have jurisdiction. Some will not have a governing law clause at all. And this is because the documentation is drafted by different parties. So the main loan agreement tends to be drafted by lawyers in London. But for some reason that I still haven't gotten my head around, and I don't know whether this lies at the lender's fault or the borrower's fault, but the other ancillary agreements tend to be drafted by Indian lawyers. And so they will not be putting in the same jurisdiction clauses as the main loan agreement. And that means that the lender then has to face proceedings in London because the defendant or borrower will be able to say, oh, no, you can only sue me in London on the basis of the main facility agreement. But for the other agreements, you need to sue me in India. And it can become a mess because you can have a number of parallel proceedings ongoing. So lenders should ensure that all jurisdiction and governing law clauses are the same. And finally, lenders should also insist on the inclusion of what is called a service agent clause in the contract. So this means in the event of a dispute, when a lender is bringing proceedings and has filed proceedings in the English court in London, they will then need to serve the proceedings on the Indian parties. And service, if there is no service agent clause, can take a really long time, maybe 8 months, sometimes even 1.5 years, under what is known as the Hague Convention on Service. So to cut that time short, if the lender includes in the documentation just a service agent clause, that means that the defaulting borrower or a borrower just has to maintain a service agent to accept all of the legal proceedings within the English jurisdiction. Can we move on to the next slide, please? The dispute life cycle. So what happens if things go wrong? And as I've explained before, of course, this can be, a willful defaulter, as they are called in India, or it can even be somebody who is just prevented from transferring money from India to repay the foreign currency loan in the UK. So what tends to happen is first the lender will file serve an acceleration notice, and that makes all of the money due and payable under the course of or duration of the loan immediately payable. So let's say it was a 20 million loan and maybe 5 million had been repaid. If there is a default, then the lender will be able to, using an acceleration notice clause in the loan documentation, send an acceleration notice, and then the remaining 15 million plus all of the interest will be repayable straight away. If that money is not paid, then they will invoke guarantees. They may also invoke the share charge procedure and appoint a receiver, as I've previously explained, under the share charge. And all of this happens even before a suit is filed in London. Can we move on to the next slide, please? So once the lender files a case in London, it can be divided, the legal case can be divided into two parts mainly. One is the interim remedies and the second is the final remedies. So an interim remedy and an extremely effective interim remedy is what is known as a worldwide freezing injunction. And this basically means that all of the borrower's assets all around the world, including in India, will be frozen. All their bank accounts will be frozen, all assets, immovable properties, etc. will be frozen. And if a borrower tries to sort of alienate or sell those assets, then in fact the freezing injunction can be served on the entity that holds those assets. So, for example, if there are shares and the example that immediately comes to mind, for example, is the Reliance dispute and with Amazon that we're seeing in the news. If a freezing injunction were brought and the shares are frozen, then service of the freezing injunction on the depositories like the CDSL, NSDL, and BSE, NSE will prevent all the shares from being transferred. So it's a very effective remedy for lenders. It was used by in the Malia matter, where after the lenders got an order from the DRT, they obtained a worldwide freezing injunction in London, and that froze all of Mr. Malia's assets. I think we've gone 2 slides ahead. Please, can we go back to? I'll just wait for that to come up. But anyway, so a worldwide freezing injunction is, and I don't know why Indian banks have shied away from making these applications for a worldwide freezing injunction, because they are effective remedies. The second is, of course, they will need to serve proceedings on the Indian defaulter. If they've not had a service agent agreement and they're trying to serve under the Hague Convention, and it's taken the major part of 1 year to try to serve the English proceedings on the Indian defaulter, then what happens? And then the lender can go to court in London and seek what is known as service by alternate means. And lastly, after a borrower has faced all of this, they may come back to court and say, no, please set aside the freezing injunction. Please set aside any service via email that you would have that you would have granted, dear court, because, for example, I had genuine reasons for not being served, or that there was a difficulty with jurisdiction because you see that the loan agreement is governed by English law, but all of these various ancillary agreements, including my guarantees, are governed by Indian law, and so you, the English court, do not have any jurisdiction. And sometimes it can be a successful way in which a borrower can come back and say, no, sorry, the English court is limited in its jurisdiction or doesn't have jurisdiction at all. The final, so moving on from interim remedies and going to the final remedies, what happens after all of these interim injunctions, etc., have been upheld is that the lender will bring something called a summary suit. It's called a summary suit in India. It's called a summary application in the UK. It's the same concept, which is that the lender will say the borrower doesn't have a good arguable case because they've essentially borrowed the money and not repaid it. And so can the English court please grant them the full judgment even without the matter going through to trial. And in most cases, the summary judgment will be granted by the English court, and that is the end of the matter, and that judgment is enforceable in India. If for some reason that judgment is not granted, so for example, if the borrower is able to say, oh no, there was some, the lender doesn't have a good arguable case because of these reasons, then the matter can go all the way to trial and a judgment will be pronounced after all of the witnesses are cross-examined. And an example of that is, again, taking a leaf out of Mr. Shankar's examples, is, for example, in one case, the borrower, and I was representing the borrower in that matter, had got an interest rate swap, but they did not get a foreign exchange swap. And they fell within those 5-year that 5-year period that Mr. Shankar said was a devastating 5-year period between 2010 and 2015. So what happened? We basically said that the lender had misrepresented to the borrower that they would grant a foreign exchange hedge, but failed to grant a foreign exchange hedge. And we said that if we knew that the lender was not going to grant us a foreign exchange hedge, then we would never have gone ahead and borrowed this money in USD. And that was a sufficient ground to put off the summary application. And so everything went to trial. And judgment was only pronounced after both witnesses were cross-examined, because it was only during cross-examination that it could be established whether or not this misrepresentation had truly been made by the bank. And lastly, the lender can also initiate legal proceedings in India. And I've seen this more and more in the last 2 years or so. So in addition to filing proceedings or bringing proceedings against the borrower in the UK, the lender also brings an NCLT matter in India, whether it be in Delhi or elsewhere. And this tends to continue in parallel with the English proceedings. So what the borrower can do in this regard is to go to the English courts and say, this is a matter which is on the basis of the same documentation and between the same parties in 2 different jurisdictions. And that means that there is a risk of irreconcilable judgment. So please, can you grant us an anti-suit injunction that prevents the NCLT proceedings from continuing? So this is, again, an anti-suit injunction is an effective remedy that a borrower can rely on. It tends to be granted, but it also equally, I would say, a 50% chance that it is not granted. Because sometimes the English courts take the view that it is the Indian proceedings are not oppressive or vexatious. Alternatively, they may take the view that the NCLT proceeding is not exactly a parallel proceeding. If the matter were at the DRT in India, that may have been a parallel proceeding to London. But because the NCLT proceedings fall within the Insolvency and Bankruptcy Code in India, therefore, they're not exactly parallel proceedings, and then the English court allows both proceedings to continue, which the borrower finds, very difficult because they have to defend cases in 2 different countries, and both cases, of course, move at different speed. Can we get the next slide, please? Mr. Kannan, I'm very pleased to stay up in the time.
Yeah, thank you, Ms. Karishma. It was a wonderful presentation, bringing out various cases, what has happened also, and what type of risks are involved. Just to start with a question, you mentioned about many times the clients, they don't understand what are the type of agreements we signed and all. So what would be your advice whenever somebody is borrowing money from abroad? What are the 5 or 6 steps they should take so that they don't get into this type of litigation?
It's essential to take advice from a cross-border specialist because lawyers tend to be qualified only in one jurisdiction, and that's natural. So either a lawyer will be qualified in India or they will be qualified in English law. But there are very few who are qualified in both. And when you are indulging in foreign currency borrowing, or indeed any documentation that is governed by a foreign law, it's very useful to run it past somebody who is qualified in both jurisdictions. So that's one. And the second is as I had said in one of my slides, which is basically the various clauses that the lenders should be careful of, which include service agent clauses and jurisdiction clauses, and making sure that all jurisdiction clauses are the same across all contracts. And secondly, for the borrowers, to make sure that the receivers cannot be appointed just by way of contract, but that they need to go to court. So the lender must need to go to court to be able to appoint the receiver. So these are the immediate things that immediately spring to mind, and of course get FEMA advice because again, as I had explained previously, if one doesn't get FEMA advice, it's very easy when one is borrowing to just simply sign all documentation, but it will come around to bite you if you have fallen foul of FEMA or you find yourself in breach of any RBI regulations, because the penalties can be quite severe. Mr. Kannan, you are on mute.
Mr. Shankar, right now there is a extreme good liquidity world over, and funds are available very cheap. And also now everybody is looking at India as a good country to enter, and also they are looking at India as a place where they can place the funds also. So in this context, what would be your advice to corporates? What kind of strategies they should follow in terms of their fundraising from abroad? What are your 3-4 points which a corporate should take into account?
So the one thing that I'd still fall back is, like I explained in my presentation, be careful not to compare apples and oranges. It's important to bring all the end of it. It's a logical decision before people put in their risk appetite and every other consideration into it. The logical aspect is the math behind it, where you compare the costs on a comparable basis and say which is cheaper or more costlier. I'll give you an example. We commonly perceive that liquidity in probably Europe is the highest at this point of time. The ECB is flooding money, interest rates are negative, so it's extremely cheap to borrow in say Europe. So we had a corporate who's got a large presence in Europe, and they wanted to raise long-term financing. They realized that it is cheaper to borrow in Rupee, swap the funds into Euro, and send it back into the European operations rather than actually borrowing Euro. So while we look at all of these, it's important to compare the costs and see where you get the highest advantage of borrowing. Like you rightly said, liquidity is flush all over the world, and fortunately, liquidity is flush in India as well. And, did we ever dream that Indian interest rates will be, 10-year sovereign rates will be sub-6 for such a prolonged period of time, or spreads over sovereign will be so low even for corporate borrowers? So the liquidity consideration cuts across both ways. The other that you should clearly keep in mind is what Karishma very well highlighted. The legal documentation and the risks related to it are not something that people should take very trivially, especially if you're doing longer tenor borrowings. There are a lot of considerations on, which jurisdiction, what are your borrowing agreements, what are your security agreements, how will enforceabilities happen. So I think it should be a fairly balanced and evaluated decision, and then the costs of these borrowings also creep in. So, for example, if you do a bilateral loan with a bank in India, the hidden cost may be very little. I mean, you really pay processing charges and that's about it. But if it is anything on foreign currency side, you've got a lot of legal charges, and if it goes into a dispute, a whole lot of litigation charges. So I think people should evaluate all of this. It's not a simple go, no go kind of an answer. So like I said, it's important to first do the math, compare the equivalence, and then put in the subjective parameters on top of it and do it. Honestly, I'd be much more comfortable with a shorter tenor borrowing rather than a longer tenor borrowing, because it's an easier decision to make. But if it's longer tenor, people should evaluate much more carefully.
Yeah, Ms. Kashmira, she wanted to ask some question. Kashmira.
Hi, thank you, Kannan, and this is really very well put forth, both Mr. Shankar and Karishma. Thanks very much. I had a question to say, if we had a chance to put forth a suggestion to the government for regulatory changes so that we can aid more of trade and more of foreign currency trade, what would those 1 or 2 points be?
So, okay, before I respond to that, or before, sorry, Karishma, you want to go? I'll wait.
No, after you.
Yeah. Okay. Sorry, I just jumped into it. Before I answer this, let me caveat it that usually finance enables economic activity. It's not the key driver for economic activity. So in that sense, there's very little finance by itself can do to override underlying economic conditions and business prospects and business liabilities. So I'm caveating that. That said, the two things that can happen is a little more flexibility for rupee lending. Now, who understands Indian corporates best? It's Indian banks. And now, Indian banks, when they give out export financing, are a little limited on how they can give it out, or even if it's foreign currency. In my slide, I spoke about other funding, which is without restrictions on tenor, end use, or pricing. If you had to do what are called FC and RB loans, you're limited on your liability side. So if you get a little more flexibility on how banks can use the liability side to do foreign currency lending in India, that's one thing that will help. The second, I think RBI has been extremely proactive on this, and they've done a lot. Our concept of ECB always has been that it's long tenor, it's used only for capex and nothing else. But today you can do an ECB for 1 year. Prepayment restrictions are far lower. The cap on interest rates is so wide that everybody pretty much fits into that bill. So I think a lot has already been done by RBI. If a lot more foreign banks found it easier to come and do their documentation and enforce their contracts legally in India, then that will make it a lot easier. So in that sense, the delta from the financing side is not very high. A lot has already been done, but yeah, there's always scope for improvement.
Ms. Karishma, your views.
Yes, from the legal side, actually, also with the IBC, with the Insolvency and Bankruptcy Code, a fair amount of work has been done, and I didn't think that I would have seen this day where the NCLT proceedings were moving quicker than the proceedings in London, and that happened up until COVID hit. So that was, a significant step forward, even on the legal front. But I'll say a couple of things, and one is actually really basic, which is what the government can do in relation to service. Because, it is appalling what I have seen in relation to service. For example, there was a $45 million loan, and that was about 8 of the 9 defendants were to be served in India. None of them accepted service. And so the bank had to go to London and say, look, they haven't accepted service, so allow us to serve via email. And what had happened is there was a miscommunication within the bank, and actually the first service had not been attempted at all. So even though this was filed just before limitation expired, the borrowers were able to come back and say, the bank was in breach of full and frank disclosure, which was necessary because it was an ex parte hearing, because only the bank was present at the service hearing and not the defaulters, obviously, because they had not been served. And so there is a duty of full and frank disclosure. And the borrowers came and said the bank had failed in that duty, and therefore they were successful in throwing that matter out of court. But because it was outside limitation now, since the bank only brought the case at the very end of limitation, the bank could not recover this money. And this is a reported judgment. It was also, in the papers and so on. But that is how bizarre it can be only in relation to service. So India has opted out of what is called service via email. And India needs to reconsider that, or it really needs to make efficient the mechanism. If they still want to say no service by email on Indian nationals and companies, then the Indian Law Ministry, which is the body that is in charge of service, needs to make their service mechanisms a lot more efficient. It should not take more than 1 year to serve. So that is what I think should be a message to the government.
Thank you.
Any other questions from other participants? We are not testing any questions. Those who are there, can you just send your questions on the chat box?
There is one question.
In the meanwhile, what is the question? Yeah, can you just read out?
It's by
there is a question.
D'Souza.
Yeah.
How about
Please.
compliance legality of foreign private direct lending in foreign currency and debt serviced from foreign receivables? Do you want to read it again?
Yeah, please.
How about compliance legality of foreign private direct lending in foreign currency and debt serviced from foreign receivables?
So if I understand the question right, it's about can a foreign liability be serviced by foreign receivables even if the receivables are not in the regular course of business is how I'm interpreting it, because if it is serviced from regular receipts from either exports or royalties or dividends from overseas investments, then there is absolutely no restriction. In fact, that's how it is meant to be, that you have a foreign currency liability and you have a foreign currency receivable that goes on to service that liability. If the question is, can it be serviced by anything else? There is no restriction on that, to the best of my knowledge. But I should caveat, I'm not the best legal person on this one. Maybe Karishma will have a better view than me on this. But as far as I see, the source of repayment, as long as it's in regular course of business or it is additional capital raised, which could include liquidation of assets overseas or fresh borrowing raised overseas, and as long as all of them are within the purview of FEMA, there is nothing that restricts that for being used for repayment of existing liabilities.
Yes, I see this very often. So foreign receivables you tend to be used actually first to repay the ECBs and other foreign currency borrowings. And all of that is fine until, again, if I may say, when it reaches a dispute stage, I think, again, the companies need to bear in mind that the foreign receivables will be very easily enforced against. It's much easier for any lender to enforce against your foreign assets and foreign receivables compared to your Indian assets and Indian receivables. So that is something to bear in mind. As far as repayment is concerned, it's exactly as Mr. Shankar has said, except if it is a group company in India that is trying to make the repayment, and it is restricted by FEMA. And this does happen in several situations. So, it's worth getting FEMA advice on whether a group company will be able to make that repayment. But no restriction on foreign receivables being used to make the repayment.
There's a question here in the chat box. For an Indian company to raise money through ECB, is there a minimum rating requirement or is it entirely dependent on the lender's risk appetite? You can hear the question, no? Yeah. It is the chat box. For an Indian company to raise money through ECB, is there a minimum rating requirement or is it entirely dependent on the lender's risk appetite?
I think it's. I don't think there is a rating requirement. In any case, the international rating will be constrained by multiple factors, including country rating, and if depending on the capital structure and if there's a parent company, and that's a logical flow for all ratings. But I don't think there is anything that restricts an Indian company rating, unless Karishma, in your experience, you've seen something where.
No, this is very much within your purview.
Yeah, so I don't think there is, to the best of my knowledge, there isn't.
Any other questions from the participants?
Yeah, can I ask a question? I'm Sunil Tordia. Yeah, this question is to anyone who can answer. Mr. Shankar, I think you will be able to answer this. A company, a mid-sized company, wants to grow its business in a foreign country, which is 100% subsidiary. Why don't bank come forward and offer us products? Okay, because generally that expertise is not available. and the risk appetite of such borrowers is very low. So is there a cell, is there a group of people in the bank who will be able to help us to restructure our financing?
So, Mr. Shardia, let me attempt that in two ways. One is, when you say a mid-sized company, usually banks will be a little circumspect about doing this. If you see the explanations that Karishma so well put out, what are all the conditions and all the precautions that both lenders and borrowers need to take. The question that always comes up to us is this corporate sophisticated enough to handle these kind of risks, either legal risks or market risks or any other risks that come with this? And she also gave an example of a mis-selling where a corporate was under the belief that there will be a hedge that's being provided by the borrower, and the borrower thought, no, I have no such obligation to provide this. Now, some of the products on the hedge side are also not very simple. You talk about currency swaps, or, you get a little more exotic. You talk about various instruments, which are all derivative instruments, and they can get really, really exotic. And the documentation related to them also can be quite complicated. At the minimum, you sign an ISDA, which itself is perhaps one of the most comprehensive yet complicated credit documents that's there in the financial markets. So if you put all of these together, even as lenders, you tend to be a little cautious about saying, how much do you want to expose your borrower to? While a lot of people think that banks and borrowers are two different counterparties, reality is that our business interests are so closely intertwined that nobody wants a default on either side, and nobody wants a situation where the other party feels that, I didn't get the right deal. So we tend to be a little cautious about these. The second is in terms of if somebody is setting up a wholly owned subsidiary, usually wholly owned subsidiaries that are being set up in an overseas country don't have either the balance sheet strength or the track record to warrant a standalone borrowing. And unfortunately, it's not very easy for guarantees to go out from India. So one of the things that happens is that the parent gives a corporate guarantee. If the parent guarantee is acceptable, then the overseas entity can borrow there. And if it's for shorter tenor, then some banks can provide SBLCs from here, based on which some overseas lending can happen. But all of these are very structured solution. It depends on the specific case. And like I said, for all of these reasons, banks tend to be a little cautious on how we finance overseas subsidiaries, especially if they are small.
Yeah, I agree with you. I have gone through similar process. But what I'm saying is, why don't banks come forward with a team of experts who can evaluate and give the right guidance? I agree with you. It is a partnership where it should make sense for bank as well as the borrower.
Yeah. Yeah. So actually, if it's a specific case, then the way I see it, most banks are fairly proactive in these solutions. And if they have an overseas presence, and now with the IBU and GIFT that's present, almost every Indian bank has a theoretical offshore presence, so they can structure solutions there. I think it's a question of conversations. So if somebody is interested, reach out to the bank. I'm sure your banks will do that evaluation.
Okay, that is the banks in Gujarat, offshore banks.
Yeah, the GIFT City branch. Yeah,
GIFT City branch. Okay.
Yeah. So till GIFT City came up, a bank in India could do overseas financing only if they had a branch overseas, or it had to be a foreign bank. But with GIFT, a lot more has happened, because the GIFT branch is, for all practical purposes, a foreign branch from a regulatory perspective. So that has opened up. So I think if you have a conversation with, whoever wants this, if they have a conversation with that bank, I think enough and more solutions will come by. I tell you our own example. There are some mid-sized companies who wanted to move out and do some investments overseas, and we have supported a lot of them. I should admit that a large part of it was on the back of comfort that we drew from the strength of the local entity, the securities that we got here, and the guarantees that we got here.
Obviously,
and in some cases, we also gave an SBLC from here to finance from overseas branches.
Okay, understood. Thank you.
Yeah, Ms. Karishma, you have any observations on this?
Yes, no, I hear what Mr. Chodia is saying, because actually it completely depends from bank to bank. And I have had clients who have found it easy to navigate and restructure because they found the right person within their bank. And there are some who just found it extremely difficult, and their authorized dealers were just completely unaware of how to restructure this. And it's not so difficult. I mean, let's say there is a parent and a subsidiary in both cases, right? So there will be an Indian corporate parent, and let's say there will be an SPV. In many cases, it's the SPVs in the Netherlands, and then the Netherlands entity owns the overseas business. And in the bank's case, there will be an Indian bank, and then there will be a subsidiary in London or in Dubai or Nassau in New York, etc. And so there is a parent in India and a subsidiary both for the borrower as well as for the bank. And if there are some restrictions to sort of make the repayment and to restructure the loan, so to make let's say there is money in India, but there isn't money in the SPV or overseas, it is possible to restructure all of this. But yes, with some banks, it's much easier than with other banks. And I've found that while assisting many of the borrowers as well.
Okay, yeah, thank you. Understood.
Any other questions? If there are no questions, no other questions, and both of you would like to just conclude what you would like to tell participants at the end of it, then I'll request Kashmira to conclude the meeting. Mr. Shankar, your last word.
So there's one question.
Yeah. Yeah, please.
From Vimal Kothari. He says, is it possible to raise a long-term loan for a hotel project with an initial moratorium of 3 years? Did you get that? Is it possible to raise a long-term loan for a hotel project with an initial moratorium of 3 years? Any of you would like to take that?
Yeah, Karishma, would you like to take that?
Oh, this is, I guess, a bank's answer, not mine.
Yeah, so I don't see a restriction. I'm not too sure offhand whether it qualifies under an automatic route or an approval route. But to the best of my recollection, it is possible under one of those routes, and depending on the restrictions, the tenors and end-use restrictions would apply. I am aware of a few corporates, a few hotels who we do business with who have got foreign currency borrowings. And I have seen both where the loans came from the parent company and also loans came from a bank overseas. So I don't see an issue with that. And moratorium is not an issue. The minimum average maturity does not actually, if there is a moratorium, you hurdle that minimum average maturity that much more comfortably. So there is no restriction. But that said, the primary consideration here would again be credit. Not all hotels are easy to finance. In hotels, the big challenge is that it's an asset where your security is good, but your cash flows need not always be so strong to service it. So that's purely a commercial decision. I don't think it's got anything to do with whether it's an ECB or a Rupee loan or any of those. So that might make it a little more, in that sense, I understand if some banks are more circumspect about doing ECBs for hotels, but from a regulatory restriction or from a possibility of doing it, I don't think there is an issue.
Karishma, you have any last word from you?
I just say it's very, it is lucrative, and it might be a good time to borrow. Please do it with your eyes open, and please take legal advice before you enter into the agreement, rather than only when things have blown up.
Yeah. Thank you, Mr. Shankar, Ms. Karishma. Actually, I will hand this over to Kashmira to propose the vote of thanks.
Thank you, Mr. Kannan. Very good evening once again to all our guests on the call. It's been a very good session, and I hope the focus group that we have present today has had great takeaways. I have. As the CI Committee on International Trade and Investment for the Western Region, it is a great pleasure to thank all our esteemed panelists for this very interesting session. Mr. Phani Shankar, President and Business Head at Kotak Mahindra Bank, you shared very practical perspectives on financial. You actually made it sound so simple, which I'm sure it's not the best way. Valid delivery and everything that you spoke about on trade financing, job conversion, FCNRB loans, and I think the good thing part, which I heard very clearly, was emphasizing that there's enough liquidity in India and globally. I'm not going down the credit and the business cycle part. But thank you, Mr. Shankar. It was such a pleasure to have you with us. Thank you once again for your time and for sharing your expertise on this call today. Karishma Vora, Barrister, England and advocate in India. Such a pleasure to have you with us today. Thank you so much for being with us. Ladies and gentlemen, Karishma mentioned that what she really reminded us about was that nothing is complete without complete and correct paperwork. And Karishma drove home the practical points, the statutory details, and shared words of caution. Thank you, Karishma, for this very detailed information so lucidly delivered. Thank you once again for being with us. We hope you're having a good time while you're still in Bombay. And to you, Mr. Kannan, for moderating this session and for bringing the best out of our eminent speakers, and for sharing your knowledge as well. Mr. Kannan, I think you should put yourself on mute.
Hello. Oh, yeah. 1 minute.
Thanks. I also thank Rajratan Global Wires for supporting this webinar as a partner. Our supporting partners allow us to put together these interesting sessions, and we're very grateful for their support, because without which it becomes a little difficult. I thank all the participants, and I really hope you found the session interesting and resourceful. I can see one last question that we were not able to address because it came in as I started speaking. I'd also like to thank the CII Secretariat, Sneha, Soni, Harsh, the IT cell of CII. Thank you for the session today and for all that you keep doing for our members. CII will continue to bring you all these knowledge sessions led by subject matter experts like we had today. This helps to increase our knowledge quotient, ensures that we avoid pitfalls and reduce risks by learning from others' rich and even sometimes painful experiences. It helps us demystify the law and identify matters that we need to put forth even under our policy and advocacy vertical. And this in turn helps industry progress. Under our International Connect series, which we bring to you very often, we've already had interactions with the countries in the UAE, the United Kingdom and Canada. We will be doing one more country very soon, probably by the end of the month or early December. Please be in touch with us and with CII so that you regularly get our updates and you can participate in all our sessions. We look forward to having all of you with us in our future interactions as well. On behalf of Sunil Charadia, my co-chair, we wish you and your families a very happy Diwali and may better times emerge. Till then, please stay safe, stay happy and healthy, and please share with those that are less fortunate than we are. Thank you once again. A very big thank you once again to Karishma and to Phani. Thank you for being with us and for sharing your expertise, your knowledge, and your time so generously with our audience today. Thank you very much, everyone. Good night and all the best to you.
Thank you.
Thank you, everyone. Thank you, Kashmira.
Thank you.